time. Ever wondered how we can predict future trends by looking at past data? That's where time series analysis comes into play. It's a powerful tool that helps us unlock patterns hidden in historical data, allowing us to make more informed decisions about what might happen next. Time series analysis isn't just about looking at numbers on a chart. It's about understanding the rhythm and flow of data over time. Whether you're analyzing stock prices, weather patterns, or sales figures, time series analysis helps you identify trends, seasonal effects, and cyclical movements that can offer valuable insights. One of the key concepts in time series analysis is recognizing the components that make up the data. You've got the trend, which shows the long-term direction, whether things are generally moving up, down, or staying flat. Then there's seasonality, the repeating patterns that occur at regular intervals, like holiday sales spikes or summer dips in energy use. And don't forget about cyclical patterns, those longer-term fluctuations that aren't tied to a specific season, but still follow a wave-like pattern over time. But what makes time series analysis truly powerful is its practical application. By analyzing past data, you can forecast future trends, helping businesses plan for demand, manage inventory, or even predict financial markets. It's like having a window into the future, based on the patterns of the past. So, as we dive into time series analysis, think about how you can use these insights in your own work. Whether it's fine-tuning your trading strategy, optimizing your business operations, or simply making better predictions, understanding time series data opens up a world of possibilities. Let's explore how these techniques can help you turn past data into future success. Time series analysis is all about diving into data points that have been collected or recorded at specific intervals over time. Picture the stock prices that fluctuate every minute, the daily temperatures that shape our weather patterns, or the monthly sales figures that reflect business performance. These are all examples of time series data. By studying these data points, we can uncover patterns and trends that aren't immediately obvious. It's like connecting the dots in a complex picture. As more data you have, the clearer the image becomes. Whether the goal is to understand how the market might behave tomorrow, anticipate the next season's weather, or forecast future sales, time series analysis provides the tools to make informed predictions based on historical trends. This method isn't just about looking back, it's about using the past to gain insights into the future. By analyzing the rhythm and flow of data over time, you can identify consistent patterns that help predict what might happen next. This kind of foresight is invaluable in fields ranging from finance to meteorology to business, where understanding and anticipating future trends can make all the difference. Let's begin by breaking down the key components of time series data, starting with the trend. The trend is the long-term movement in the data over time, showing you the overall direction in which things are heading. Imagine looking at the stock market over several years. Even though there are ups and downs along the way, you might notice that the general movement is upward. That's the trend at work, a broad, sweeping direction that reveals whether the data is generally increasing, decreasing, or staying relatively stable over time. Understanding the trend is crucial because it provides context for the data points you're analyzing. It helps you see beyond the day-to-day fluctuations and focus on the bigger picture. Whether the trend is upward, downward, or flat, it sets the stage for interpreting everything else you observe in the data. Identifying the trend allows you to make more informed decisions, whether you're investing in the stock market, forecasting sales, or planning for the future. The second key component of time series data is seasonality. Seasonality refers to the regular patterns that repeat over a known, fixed period, such as monthly, quarterly, or even annually. These patterns are often driven by factors like holidays, weather changes, or economic cycles, and they can have a significant impact on the data. For example, consider retail sales. You'll often see a spike during the holiday season as shoppers flock to stores and online platforms for gifts and festive purchases. This increase isn't random, it's a predictable pattern that repeats every year. Recognizing these seasonal patterns is essential for businesses as it allows them to plan their strategies more effectively. They can stock up on inventory before the holiday rush, adjust marketing efforts to capitalize on seasonal demand, or manage staffing levels to handle the expected increase in customer traffic. By identifying and understanding seasonality, businesses can make smarter decisions, ensuring they're prepared for the ebb and flow of their industry. Whether it's planning promotions, budgeting for the year, or forecasting demand, recognizing these seasonal trends helps businesses stay ahead of the curve and maximize their opportunities. Next, let's talk about cyclic patterns. Unlike seasonality, which has a fixed and predictable frequency, cyclic patterns are long-term oscillations that don't adhere to a set schedule. These cycles are often influenced by broader economic conditions, such as periods of economic growth, known as booms, and downturns, known as recessions. Cyclic patterns can have a significant impact on data over time. For instance, think about the stock market. Over several years, you might see cycles where prices rise during economic booms and fall during recessions. These ups and downs are not tied to specific dates or seasons, but are driven by the broader economic environment. Understanding cyclic patterns is crucial because they can shape the long-term movement of your data. While they don't have the regularity of seasonal patterns, they still influence trends and can affect decision-making. For example, recognizing that a market is in a boom cycle might encourage you to invest more aggressively, while a looming recession could prompt more caution. By identifying and analyzing cyclic patterns, you gain insight into the larger forces at play in your data, helping you make more informed predictions and strategic decisions over the long term. Finally, let's discuss irregular variations. These are the random or unpredictable fluctuations in your data that don't follow any discernible pattern. Unlike trends, seasonality, or cyclic patterns, irregular variations are caused by unexpected events, things like natural disasters, political upheavals, or sudden economic shocks. These variations can be disruptive, causing sharp and sudden changes in your data that aren't easy to predict or analyze. For example, a natural disaster might lead to a sudden drop in production for a specific industry, or a political event could cause immediate fluctuations in stock prices. These irregular variations are essentially the noise in your data, anomalies that can skew your analysis if not properly accounted for. Understanding and isolating these irregular variations is crucial for accurate time series analysis. By identifying these outliers, you can focus more on the underlying patterns and trends that truly matter. Techniques like smoothing or filtering can help to minimize the impact of these irregularities, ensuring that your analysis remains robust and reliable. Incorporating this understanding into your time series analysis allows you to differentiate between the regular patterns and the random noise, leading to more accurate forecasts and better decision-making. Now that we've covered the components of time series data, let's dive into some methods of time series analysis, starting with moving averages. Moving averages are a popular technique because they help smooth out short-term fluctuations and reveal longer-term trends that might otherwise be obscured by daily or weekly volatility. Here's how it works. A moving average calculates the average value of your date over a specified number of periods. For example, if you're analyzing stock prices, a 50-day moving average would take the average closing price of the stock over the last 50 days. Each day, as new data comes in, the oldest data point drops off and the average is recalculated. This creates a smooth line that moves along with your data, giving you a clearer picture of the underlying trend. The beauty of moving averages is that they reduce the noise in your data, making it easier to identify the overall direction, whether the trend is up, down, or sideways. For instance, if the 50-day moving average is steadily climbing, it suggests that the stock has been consistently gaining value over that period, despite any short-term dips or spikes. Moving averages are particularly useful in trading and investment strategies, as they help you spot potential entry and exit points. For example, when the current price crosses above the moving average, it might signal the start of an upward trend, indicating a good time to buy. Conversely, if the price drops below the moving average, it could suggest a downtrend, prompting a potential sell. By using moving averages, you can cut through the short-term volatility and focus on the bigger picture, making it easier to understand where the market or data is headed and to make more informed decisions based on that insight. Another powerful method in time series analysis is exponential smoothing. Unlike moving averages, which treat all data points equally, exponential smoothing gives more importance to recent data points, making the analysis more responsive to changes in the data. This technique is particularly useful for making short-term forecasts where recent trends are more relevant than older ones. The key to exponential smoothing lies in its ability to adjust the weight given to recent data versus older data. This is done through a smoothing parameter, often denoted as alpha. By adjusting this parameter, you can control how much emphasis is placed on the most recent data points. A higher alpha value gives more weight to the latest data, making the forecast more sensitive to recent changes. Conversely, a lower alpha value smooths out the data more, making the model less reactive to short-term fluctuations. For instance, if you're forecasting sales and you know that recent trends are likely to continue, you might set a higher alpha to make your model more responsive to those recent patterns. This approach is especially useful in dynamic environments where conditions change rapidly, and you need your forecasts to reflect those shifts as closely as possible. Exponential smoothing is also relatively simple to implement, making it a popular choice for short-term forecasting in various fields, from finance to inventory management. It helps you stay on top of recent trends without being overly influenced by older data that may no longer be relevant. By using exponential smoothing, you can create forecasts that are not only accurate but also timely, allowing you to respond quickly to changes in the data and make more informed decisions in the short term. Decomposition is indeed a powerful technique in time series analysis, offering a structured way to break down complex data into more understandable parts. By decomposing time series data, you can separate it into its fundamental components, the trend, seasonality, and irregular variations. This approach helps you to better understand the underlying patterns and make more accurate forecasts. Imagine you're working with monthly sales data. This data likely includes a mix of different influences, a long-term growth trend, seasonal peaks during certain months, and random fluctuations that don't follow any specific pattern. Decomposition allows you to disentangle these elements, giving you a clearer view of each one individually. First, the trend component shows the overall direction in which the data is moving over time, whether that's upward, downward, or relatively stable. This trend reflects the general growth or decline in sales, which is critical for long-term planning. Next, the seasonality component captures the regular, repeating patterns that occur at specific intervals, such as increased sales during the holiday season. By isolating seasonality, you can better anticipate these recurring fluctuations and plan accordingly, whether it's stocking up on inventory or adjusting marketing efforts. Finally, the irregular component represents the random noise or unexpected events that can affect your data. These are the unpredictable variations that don't fit into the trend or seasonality patterns, like a sudden spike in sales due to an unexpected event. By isolating these irregularities, you can focus more on the true underlying patterns. Decomposition provides a comprehensive way to analyze time series data by breaking it down into these essential components. By understanding each part, you can make more informed and accurate forecasts, allowing you to better anticipate future trends, manage risks, and optimize your strategies. Whether you're forecasting sales, managing inventory, or analyzing market trends, decomposition helps you see the full picture and make decisions based on a deeper understanding of the data. Let's dive into a practical application of these methods using stock market data, where moving averages are a go-to tool for identifying trends and making informed trading decisions. Consider a 50-day moving average, a popular choice among traders. By plotting this moving average on a stock chart, you effectively smooth out the daily fluctuations in stock prices. This gives you a clearer view of the underlying trend, helping you see the bigger picture without being distracted by the day-to-day noise. For example, if you plot a 50-day moving average alongside the current stock price, you can start to identify potential buy or sell signals. When the current stock price crosses above the moving average, it could signal the beginning of an uptrend, suggesting a good time to buy. Conversely, if the stock price falls below the moving average, it might indicate the start of a downtrend, signaling a potential sell opportunity. This approach works because the moving average acts as a dynamic indicator of the stock's momentum. It reflects the market's consensus over the past 50 days, giving you a benchmark to compare the current price against. If the price moves significantly above the average, it suggests strong bullish momentum. If it drops below, it indicates bearish momentum may be taking over. By using moving averages in this way, traders can filter out short-term volatility and focus on the long-term trend, making it easier to make decisions based on the overall direction of the market. This method is not only practical, but also versatile, making it a staple in the toolkit of many successful traders. Using RTrader Pro, you can effortlessly set up moving averages to enhance your market analysis. This platform is equipped with powerful tools for time series analysis, giving you the flexibility to customize your charts and indicators to suit your trading strategy. Setting up moving averages in RTrader Pro is a straightforward process. Start by selecting the stock you want to analyze. Once you've chosen your stock, navigate to the Indicators section and select the Moving Average indicator. You'll then have the option to set the desired period, such as 50 days, depending on the trend you're looking to capture. With just a few clicks, you can overlay the moving average onto your stock chart, giving you a clearer view of the overall trend by smoothing out the daily price fluctuations. This visual representation helps you spot potential buy or sell signals by comparing the current stock price to the moving average line. RTrader Pro's robust capabilities allow you to fine-tune these settings, experiment with different time periods, and combine moving averages with other indicators to gain deeper insights into the market. Whether you're looking to identify long-term trends or spot short-term opportunities, setting up moving averages in RTrader Pro provides a powerful tool to guide your trading decisions. Now, let's dive into some advanced techniques, starting with one of the most popular models for forecasting future data points, ARIMA model, which stands for Autoregressive Integrated Moving Average. ARIMA models are powerful tools that leverage historical data to make accurate predictions about future trends. The strength of the ARIMA model lies in its ability to handle a variety of time series data, especially those that show signs of non-stationarity, where the data's statistical properties change over time. ARIMA works by combining three key components: autoregression, integration, and moving average. The autoregressive AR part of the model uses the relationship between an observation and a number of lagged observations, essentially looking at how past values influence current values. This helps in identifying patterns where past data points predict future ones. The integrated eye component deals with making the data stationary, which is crucial for accurate forecasting. Stationarity means that the statistical properties of the series, like the mean and variance, are constant over time. The integration part of ARIMA achieves this by differencing the data, subtracting the previous observation from the current one to remove trends or seasonal effects. Finally, the moving average MA component models the relationship between an observation and a residual error from a moving average model applied to lagged observations. This helps smooth out the noise in the data, allowing the model to focus on the underlying trends. By combining these elements, ARIMA models can effectively capture the nuances of time series data, making them highly effective for forecasting. Whether you're looking at stock prices, sales data, or economic indicators, ARIMA provides a structured approach to predicting future values based on the patterns found in historical data. This model is particularly valuable for traders and analysts who need reliable forecasts to inform their decision-making. With ARIMA, you can develop more accurate and data-driven strategies, giving you an edge in anticipating market movements and planning for the future. To fit an ARIMA model effectively, you'll want to follow a series of methodical steps, each designed to ensure that the model is well suited to the day you're analyzing and capable of making accurate predictions. First, begin by identifying the model. This involves analyzing the data's autocorrelation and partial autocorrelation plots, often referred to as ACF and PACF plots. These plots help you determine the order of the ARIMA model specifically, how many autoregressive AR terms, differences I, and moving average MA terms to include. The ACF plot shows the correlation between the data points and their lagged values, while the PACF plot reveals the correlation after accounting for the relationships explained by earlier lags. By interpreting these plots, you can identify the initial parameters for your ARIMA model. Next, estimate the model parameters using maximum likelihood estimation (MLE). This statistical method finds the parameter values that make the observed data most probable under the model. The goal here is to fine-tune the ARIMA model by optimizing its parameters, ensuring that it best fits the historical data. During this step, you'll adjust the coefficients for the AR and MA terms, as well as the differencing order, to minimize the errors between the model's predictions and the actual data. After fitting the model, it's crucial to check its accuracy. Start by examining the residuals, differences between the model's predictions and the actual data. The residuals should resemble white noise, meaning they should have a mean of 0 and no significant autocorrelation. If the residuals display patterns, it suggests that the model hasn't captured all the information in the data and may need further refinement. Additionally, perform diagnostic tests like the Leung box test to statistically assess whether the residuals are independent and identically distributed. Once you have a well-fitted ARIMA model, you can confidently use it to predict future values in your time series data, such as stock prices or economic indicators. The model leverages the patterns identified in the historical data to generate forecasts, helping you make informed decisions based on data-driven insights. With a robust ARIMA model, you're equipped to anticipate future trends with greater accuracy, enhancing your ability to navigate the complexities of financial markets or other time-sensitive data environments. For instance, consider using an ARIMA model to predict future stock prices based on historical data. By analyzing past price movements and identifying patterns within the data, the ARIMA model can generate forecasts that offer valuable insights for making informed trading decisions. This approach becomes particularly useful in volatile markets, where predicting future trends can be especially challenging. In a volatile market, price movements can be erratic and difficult to anticipate using basic methods. However, by applying an ARIMA model, you can capture the underlying patterns in historical data, including trends and cycles that might not be immediately obvious. The model processes this data, accounting for factors like past price levels and fluctuations, to produce a forecast that reflects the most likely future outcomes. This predictive power is crucial when navigating fast-moving markets. For example, if the ARIMA model suggests that a stock's price is likely to rise based on historical trends, you might decide to buy in anticipation of future gains. Conversely, if the model forecasts a potential decline, you might choose to sell or hold off on buying. The ARIMA model doesn't just provide a guess, it offers a statistically grounded prediction that incorporates past data to inform future actions. By using this model, you can approach trading with greater confidence, armed with a tool that helps you anticipate market movements and react more strategically. Whether you're looking to capitalize on upward trends or mitigate risks in a downturn, the insights gained from an ARIMA model can be a significant asset in your trading arsenal. Another essential tool for managing risk in trading is the stop-loss market order. This order is designed to protect your investments by automatically selling your stock if it reaches a predetermined price, effectively minimizing potential losses. In volatile markets, where prices can fluctuate rapidly, a stop-loss order acts as a safety net, ensuring that your losses are limited if the market moves against you. For example, suppose you buy a stock at $100. To manage your risk, you set a stop-loss order at $90. This means that if the stock price falls to $90, your position will be sold automatically. By doing so, you limit your loss to $10 per share, protecting your capital from further decline. The beauty of a stop-loss order is that it doesn't require constant monitoring of the market. Once set, it works in the background, ready to execute the sale if the stock hits your specified price. This allows you to trade with more confidence, knowing that you have a plan in place to mitigate losses in case the market takes an unexpected turn. In essence, stop-loss market orders are a simple yet powerful tool that helps traders manage risk effectively. Whether you're dealing with individual stocks or a broader portfolio, incorporating stop-loss orders into your strategy ensures that you can safeguard your investments and maintain control, even in the face of market volatility. To set a stop-loss order in RTrader Pro, start by selecting the stock you want to protect. Once you've chosen your stock, navigate to the Order Type menu and select Stop Loss Order. This option is specifically designed to help you manage risk by automatically selling your position if the stock reaches a certain price. Next, enter your trigger price. This is the specific price at which you want the stop loss order to be executed. For example, if you bought the stock at $100 and want to limit your losses to $10 per share, you would set the trigger price at $90. After entering your trigger price, take a moment to review the details of your order. Make sure everything is set up correctly from the stock selection to the trigger price. Once you're satisfied, confirm the order. This simple but powerful tool allows you to manage risk effectively, ensuring that your losses are contained if the market moves against you. By setting a stop-loss order, you can trade with greater peace of mind, knowing that you have a plan in place to protect your capital in volatile market conditions. Market limit orders are another valuable tool in your trading strategy, providing you with greater control over your entry and exit points. Unlike market orders, which execute at the current market price, market limit orders only execute when the stock reaches your specified price or better. This ensures that you get the price you want without needing to constantly monitor the market. For example, suppose you want to buy a stock, but only if the price drops to $50 or lower. You can set a market limit order at $50. This means that your order will only be executed if the stock's price reaches $50 or falls below it. If the stock remains above $50, the order won't be filled, protecting you from paying more than you're willing to for the stock. This type of order is particularly useful when you have a clear idea of the price you want to pay or receive, but don't have the time or ability to watch the market continuously. It allows you to set your conditions and then step away, knowing that your trade will only go through if it meets your criteria. Whether you're looking to buy at a favorable price or sell when the market hits your target, market limit orders give you precise control, helping you stick to your trading strategy and avoid unfavorable transactions. Stop limit orders are a versatile tool that combines the features of both stop and limit orders, offering you greater control over your trades. These orders allow you to set specific conditions for a trade, ensuring it only executes within a defined price range. This added control can be especially beneficial in volatile markets where prices can move rapidly. Here's how it works. Let's say you own a stock and want to protect yourself from a significant price drop. You could set a stop limit order to sell the stock if the price falls to $48. But instead of just selling at any price below $48, you set a limit of $47.50. This means that if the stock's price drops to $48, your stop limit order is triggered, but the trade will only execute if the price remains at or above $47.50. If the price falls below that limit, the order won't execute, protecting you from selling at an even lower price than you're comfortable with. This setup gives you more flexibility and control, allowing you to manage risk more precisely. You can ensure that your trades occur only within a price range that aligns with your strategy, rather than leaving it entirely to market forces. In volatile markets, this can be particularly useful as it allows you to respond to price movements with a clear, pre-defined plan, reducing the impact of sudden fluctuations on your trading decisions. Comparing these different order types gives you a clearer understanding of when to use each one based on your trading goals and the current market conditions. Market limit orders are ideal when your primary focus is on controlling the execution price. These orders ensure that your trade will only execute at your specified price or better, giving you the certainty that you won't pay more or sell for less than what you've planned. This makes market limit orders especially useful when you have a specific entry or exit price in mind and are willing to wait until the market reaches that level. Stop orders, on the other hand, are designed primarily for managing risk. They automatically trigger a trade when the market hits a certain price, which is particularly valuable in volatile markets. A stop order ensures that if the market moves against you, your position will be sold or bought automatically, limiting your potential losses. This makes stop orders an essential tool for protecting your investments and ensuring you don't experience larger than expected losses. Stop limit orders combine the benefits of both stop and limit orders, providing a balance between price control and risk management. With a stop limit order, you set a trigger price, just like a stop order, but you also set a limit to ensure that the trade only executes within a certain price range. This approach gives you the ability to manage risk by triggering the trade at a specific price, while also ensuring that you don't sell or buy at a price that doesn't meet your criteria. Stop limit orders are particularly useful in volatile markets, where you want to maintain some control over the execution price while still having a safety net in place. By understanding the strengths and purposes of each order type, you can make more informed decisions and choose the right tool for each situation, whether your priority is price control, risk management, or a balance of both. Let's delve into some practical trading tips that can help you make the most of time series analysis. One critical aspect is setting effective stop-loss levels, which plays a vital role in protecting your capital while avoiding premature exits from potentially profitable trades. To set these stop-loss levels effectively, start by identifying key support and resistance levels on your charts. Support levels are price points where a stock tends to find buying interest, preventing it from falling further. Resistance levels, on the other hand, are price points where selling interest typically prevents the stock from rising higher. These levels are crucial because they represent areas where the price has historically had difficulty moving past, making them ideal reference points for placing your stop-loss orders. For example, if you've identified a strong support level on your chart, setting your stop-loss just below this level can be a strategic move. This way, you give the stock room to move without exiting too early during normal market fluctuations. The idea is to avoid being stopped out by minor dips, which might occur even if the stock is still in an overall uptrend. On the flip side, if you're shorting a stock, you might set your stop loss just above a key resistance level. If the price breaks through this resistance, it could signal a reversal in the trend, prompting you to exit the trade to avoid further losses. By aligning your stop-loss orders with these key levels, you create a buffer that protects your position while allowing the stock to move naturally. This approach helps you avoid the frustration of being stopped out of a trade too early, only to see the stock rebound shortly after. It also ensures that your capital is protected in case the stock moves decisively against you. Incorporating these principles into your trading strategy can make a significant difference in your overall performance. By setting stop-loss levels based on solid chart analysis, you enhance your risk management, allowing you to trade with more confidence and precision. Another valuable strategy is using market limit orders to optimize your trade entries and exits. This approach allows you to set precise price points at which you're willing to buy or sell, ensuring that your trades only execute at favorable prices, which can help maximize your potential profits. When setting up a market limit order for entering a trade, you typically want to identify a key price level where you believe the stock offers good value. This might be at a strong support level where the price has previously bounced higher, indicating that buyers are likely to step in again. By setting your limit order just above this support level, you can enter the trade at a price that has a higher probability of rising, improving your chances of a profitable trade. Similarly, when planning your exit from a trade, market limit orders allow you to lock in gains by selling at a predetermined price. For instance, if you've identified a resistance level where the stock has struggled to break through in the past, setting a limit order to sell just below this level can ensure that you exit the trade at a peak, capturing your profits before the price potentially reverses. This strategy is particularly useful in volatile markets, where prices can fluctuate rapidly. Instead of chasing the market and risking less favorable prices, you set your conditions in advance. The trade will only execute when the market reaches your desired price, providing you with greater control over your transactions. By using market limit orders in this way, you align your trading actions with key technical levels, ensuring that you're buying or selling when the odds are more in your favor. This method not only helps you maximize profits, but also adds discipline to your trading, reducing the emotional impact of market movements and helping you stick to your strategy. Combining stop limit orders with chart patterns can indeed elevate your trading strategy by allowing you to respond to key technical signals with precision. For example, consider the head and shoulders pattern, a classic chart pattern that often signals a reversal from an uptrend to a downtrend. When you identify a head and shoulders pattern on your chart, the neckline line drawn through the lows of the pattern becomes a critical level. If the price drops below this neckline, it typically confirms the pattern and suggests that the trend is reversing downward. This is where a stop limit order can be particularly effective. You can set a stop limit order to sell if the price falls below the neckline. By doing this, you establish a strategy that protects your gains while minimizing potential losses. The stop price is set just below the neckline, triggering the order if the price reaches this level. The limit price is set slightly below the stop price, ensuring that your trade is executed within a controlled range, even if the market becomes volatile. This approach allows you to exit your position promptly if the bearish signal is confirmed, protecting your capital from a significant downturn. At the same time, by using a stop limit order rather than a simple stop order, you maintain control over the execution price, avoiding the risk of selling at a price lower than anticipated due to a sudden market drop. Integrating stop limit orders with chart patterns like the head and shoulders not only strengthens your risk management, but also helps you capitalize on key market signals. This combination ensures that your trades are aligned with technical analysis, allowing you to make more informed decisions and optimize your overall trading performance. Customizing chart layouts for better analysis is a practical and effective tip that can significantly enhance your trading experience. When you arrange your charts and indicators in a way that aligns with your trading style, you streamline your workflow, allowing you to quickly identify trends, spot opportunities, and make more informed decisions. Most trading platforms like RTrader Pro offer robust customization options that enable you to tailor your workspace to fit your specific needs. You can choose which charts to display, the time frames to focus on, and which indicators to overlay. By organizing these elements thoughtfully, you create a more intuitive and efficient environment that supports your analysis and trading strategy. For instance, if you're a trader who relies heavily on trend analysis, you might set up multiple charts with different time frames such as daily, hourly, and 15-minute charts all displaying the same stock. This A timeframe approach allows you to get a broad overview of the long-term trend while also drilling down into the finer details of short-term movements. You can also arrange your indicators in a way that highlights the information most critical to your strategy. For example, placing moving averages, volume, and other key indicators directly on your main chart ensures that you can easily interpret price action in the context of these tools. Alternatively, you might prefer to keep certain indicators in separate windows to reduce clutter and maintain a clean, focused view. In addition to arranging charts and indicators, consider customizing the colors, grid lines, and other visual elements of your charts to make them easier to read and interpret quickly. The goal is to create a layout that feels natural and supports your decision-making process, minimizing the time it takes to analyze data and execute trades. By taking full advantage of the customization options available on platforms like RTrader Pro, you can design a trading workspace that enhances your ability to perform detailed analysis and respond swiftly to market changes. This personalized setup can lead to more efficient trading, better analysis, and ultimately, more successful outcomes. Let's explore some of the key tools and platforms available for time series analysis, which are essential for traders and analysts aiming to gain deeper insights and make accurate forecasts. R and Python are two of the most popular programming languages for time series analysis. Both offer powerful libraries and packages specifically designed for statistical modeling, data manipulation, and visualization. In R, packages like Forecast, Series, and Profit provide comprehensive tools for analyzing and predicting time series data. These tools allow you to perform everything from simple moving averages to complex ARIMA models, all within a flexible and scriptable environment. Python, on the other hand, offers robust libraries like Pandas, Stats Models, and scikit-learn, which are widely used for handling time series data, building models, and making predictions. Python's versatility and ease of integration with other systems make it a go-to choice for many analysts. For those who prefer a more specialized, user-friendly platform, software like RTrader Pro offers a range of features tailored specifically for traders. RTrader Pro provides advanced charting tools, real-time data analysis, and built-in indicators that can be customized to suit your trading strategy. Its time series analysis capabilities are particularly valuable for those who want to quickly identify trends, test strategies, and make informed trading decisions without the need for extensive programming knowledge. These tools not only help you analyze historical data, but also enable you to create forecasts, test different scenarios, and optimize your strategies. By leveraging the strengths of R, Python, or specialized platforms like RTrader Pro, you can delve deeper into the data, uncover patterns, and gain a competitive edge in the market. Whether you're a seasoned analyst or a trader looking to refine your approach, these tools are invaluable for turning raw data into actionable insights. Using RTrader Pro, you can fully leverage advanced time series analysis and implement sophisticated trading strategies with ease. The platform offers a comprehensive suite of tools that allow you to set up moving averages, fit ARIMA models, and customize your charts to match your trading style. One of the standout features of RTrader Pro is its ability to facilitate time series analysis directly within the platform. For instance, you can easily set up moving averages to smooth out price data and identify long-term trends, helping you to make more informed trading decisions. If you're looking to delve deeper into forecasting, the platform also supports the fitting of ARIMA models, allowing you to analyze historical data and predict future market movements with greater accuracy. Customizing your charts is another powerful capability in RTrader Pro. You can arrange your charts, choose specific indicators, and tailor the visual elements to create a trading environment that enhances your analysis and decision-making process. This customization ensures that the most relevant information is always at your fingertips, enabling you to react quickly to market changes. In addition to these analytical tools, RTrader Pro also provides robust alert and notification systems. You can set up alerts for significant market movements, such as when a stock reaches a certain price or when there's a sudden spike in volume. These alerts help you stay informed in real time, ensuring that you don't miss critical opportunities or warning signs, even when you're not actively monitoring the market. By combining these features advanced time series analysis, customizable charts, and real-time alerts, RTrader Pro empowers you to implement and refine your trading strategies effectively. Whether you're focused on identifying trends, predicting future prices, or responding swiftly to market shifts, the platform provides the tools you need to make timely and well-informed decisions in a fast-paced trading environment. As we wrap up, think about how you can apply these tips and techniques to your trading. What features are you most excited to try? How can you customize your real-time stock charts to fit your trading style? Thank you for joining us today. We hope this tutorial has been helpful and that you feel more confident using real-time stock charts and time series analysis. Keep exploring, keep analyzing, and see you next